Imagine waking up to check your crypto portfolio and seeing a single token you bought for a few dollars now worth $100 or more. That's the dream some XRP holders are sharing today. They point to a looming 12 trillion unlock of tokenized assets, regulated stablecoin frameworks, and new exchange-traded funds, ETFs, as catalysts that could propel XRP into triple-digit territory. But is such a meteoric rise really possible? In this video, you'll get a beginner-friendly, step-by-step explanation of how XRP works, why its supply mechanics are unique, and what real-world events could drive massive demand. By the end, you'll know what needs to happen for XRP to reach 3 digits, and what risks still stand in the way. Let's dive in. To understand why people talk about triple-digit prices, you first need to understand supply. XRP is not mined like Bitcoin. All 100 billion XRP tokens were created at launch. Today, roughly 54 billion XRP are in circulation. The rest are locked in escrow or held by Ripple Labs, the company that develops the XRP ledger. Every month up to 1 billion XRP are released from escrow, and any unused portion goes back into escrow. A tiny fraction of XRP is burned with each transaction to prevent spam. Why does this matter? A fixed supply combined with steady demand can drive price appreciation. Unlike currencies that inflate their supply, XRP's total number of tokens never changes. Over time, it actually decreases slightly due to transaction burns. In addition, ownership is concentrated. Ripple Labs controls about 40–45% of the supply through escrow accounts, while exchanges and a small group of whales hold another sizable chunk. Only about 1/4 of the supply is widely distributed among retail investors. That means there aren't many tokens available on the open market. If demand spikes suddenly, say from institutional investors, there could be a supply shock. Triple-digit predictions often reference a coming tokenization boom. Tokenization is the process of putting real-world assets, think stocks, bonds, real estate, and even commodities, on a blockchain so they can trade seamlessly. Analysts estimate that trillions of dollars worth of assets could move on-chain in the coming years. You might be wondering, what does that have to do with XRP? The XRP ledger was designed from the start for fast, low-cost, cross-border payments. Settlement times average 3.5 seconds, and transaction fees are fractions of a cent. These features make it attractive not only for remittances, but also for tokenizing real-world assets, RWAs. Recent partnerships illustrate the trend. A Brazilian bank moved over $1 billion worth of real on the XRP ledger in a single quarter. European partners are testing euro-denominated stablecoins with similar volumes. Ripple Labs launched RLUSD, an over-collateralized stablecoin backed by US Treasuries and cash reserves. Tokenizing these assets on the XRP ledger provides two things: liquidity and utility. It's not enough to lock value on a blockchain. For prices to rise, value must move. When banks and companies start transacting tokenized real-world assets at scale, they need XRP, or other native tokens, to pay fees and provide liquidity. That creates sustained demand. Another driver you hear about is the rise of crypto treasury companies. These are firms that buy crypto as a reserve asset, similar to how MicroStrategy holds Bitcoin. They hold tokens on their balance sheet not as speculative trading inventory but as a long-term store of value. A handful of companies have already started accumulating XRP. Imagine dozens more following suit. Here's why that could be significant. Supply on exchanges is limited. If treasury companies buy millions of XRP and lock them away, those coins disappear from trading. That could lead to a supply shock, where there simply aren't enough tokens to meet new demand. It's similar to what happened with Bitcoin when institutional custody providers started hoarding coins. Of course, there's risk. If XRP's price falls before these companies can realize gains, they could face liquidity issues. Regulation also plays a role. Until recently, the United States lacked clear rules for stablecoins and digital commodities. That's changing. Two pieces of U.S. legislation passed in mid-2025 aim to bring the regulatory clarity investors and institutions have been waiting for. Genius Act. This bill sets up the first federal framework for payment stablecoins. It requires issuers to back their tokens 100% with cash and U.S. Treasuries. It also mandates robust reserve disclosures and consumer protections. By guaranteeing that stablecoins are fully collateralized and transparent, the law paves the way for banks, payment processors, and corporations to adopt them confidently. More importantly for XRP, Genius integrates stablecoins into existing U.S. payment rails, opening the door for tokenized payments on regulated infrastructure. Clarity Act. The Digital Asset Market Clarity Act addresses the "who regulates what" dilemma. It grants the Commodity Futures Trading Commission, CFTC, exclusive jurisdiction over cash or spot markets for digital commodities. This closes the so-called spot market gap by creating new regulated entities, digital commodity exchanges, brokers and dealers that must register with the CFTC. The act also introduces a path for projects to raise capital while exempting certain digital commodities from securities classification. In plain terms, it clarifies whether a token is a commodity or a security, reducing legal uncertainty and encouraging institutional participation. Regulatory clarity is critical. Institutions with trillions of dollars under management cannot invest in assets with ambiguous legal status. By defining rules for stablecoins and digital commodities, these acts lower the risk of enforcement surprises and encourage mainstream adoption. They also complement Ripple's ongoing settlement with the SEC, which clarified that XRP is not a security when sold on exchanges, a major milestone for the token. Crypto ETFs are another potential game changer. ETFs let everyday investors gain exposure to assets without holding them directly. Bitcoin spot ETFs launched in early 2024 and have attracted tens of billions of dollars. Ether ETFs followed. Analysts expect XRP ETFs to be next, especially now that futures contracts for XRP have been trading on the Chicago Mercantile Exchange for over 6 months. Why does this matter? Suppose a spot XRP ETF launches and attracts $5 billion in its first month. At a price of $3, it would need roughly 1.67 billion XRP to back its shares. That's 3% of the entire circulating supply. If multiple ETFs launch and each pulls in billions, the demand for XRP could exceed the supply available on exchanges. Moreover, crypto markets exhibit a curious phenomenon. Small inflows can produce outsized market cap increases. When order books are thin, a few $1,000,000 in net buying can push market cap up by tens of millions or more. This is sometimes called the multiplier effect. In practice, it means it may not take trillions of dollars to drive XRP's market cap from a few hundred billion to several trillion. However, you should remember that multipliers work both ways. Selling can cause sharp declines just as easily. So, will XRP hit $100 or even $1,000? Here's a realistic way to think about it. Double-digit prices. Many analysts expect ETFs and institutional inflows to push XRP into the double-digit range, $10, $20, or even $30 within a couple years. That would require tens of billions of dollars in net inflows, which seems achievable if multiple ETFs gain traction. Triple-digit prices. Getting to $100 or more would require hundreds of billions in net inflows and sustained demand. The tokenization of real-world assets, adoption of regulated stablecoins, and widespread use of XRP for liquidity could provide this over the long term. But it's unlikely to happen quickly. It took gold nearly a decade to 5x after its ETF launched. $1,000 XRP. This is largely speculative. It would imply a market cap approaching 60 trillion. While not impossible in a fully tokenized global economy, it would require a massive migration of value onto blockchains and near-universal adoption of XRP for payments and liquidity. That scenario is far from guaranteed. It's important to remember that crypto markets are volatile. Even if XRP hits new highs after ETF launches, prices could retrace 30–50% in a matter of weeks. Long-term investors should be prepared for these swings and avoid investing money they can't afford to lose. Prepare, don't speculate. XRP's journey from under $1 to triple digits hinges on multiple factors: a fixed and gradually deflating supply, regulatory clarity for stablecoins and digital assets, real-world asset tokenization on the XRP ledger, the emergence of crypto treasury companies, and potential ETFs that could channel billions into the token. These catalysts could combine to create a supply-demand imbalance unlike anything we've seen before. However, no outcome is guaranteed. Triple-digit targets grab headlines, but they also carry significant risk. Markets can be irrational longer than you can remain solvent. Instead of chasing lofty numbers, focus on understanding the fundamentals, diversifying your portfolio, and staying informed about regulatory and technological developments. If you enjoyed this deep dive and want more crypto, economics, geopolitics, and finance insights delivered in an easy-to-understand way, subscribe to Express Econgeo Finance Insights and share your questions in the comments. Your financial education journey has just begun.